Welcome to the InterMarket Analysis video update. This is a video that I do every week where we look at a number of different things that ultimately impact the S&P 500. We look at the valuation of the S&P. We look at growth versus value. We want growth to be doing better in a more positive environment. And we look at other markets and sectors to see how are they doing independently and how are they doing compared to the S&P. There's also an additional session this time. I was able to record the weekly video earlier than usual, but it was before the Isabel Net blog charts were updated. Those have been added to this video, so it'll make it just a little bit longer than usual. This is being prepared for Monday, February 10th. Here are some Isabel Net blog charts. These are earnings projections going out, and the big takeaway is that we're going up and to the right with the arrow. And that just means, even though they're slowing down a little bit here, they're not quite as robust as we've seen in the past, they're still going up. And that justifies higher stock prices. Okay, because we have the Super Bowl coming up, AFC winners have been very good for Bulls lately. Well, we'll have to see. Is Kansas City going to be able to three-peat here? Do I have to pay to use that since it's a copyright word? Copyrighted, copywritten. Not sure how to say that, but it just says when the AFC wins, the market tends to do well. They have indicators for everything. They have one for baseball, now football, probably have one for the NBA, and one of the older football teams wins or the whatever. You can get all crazy with this stuff. All right, then the number of stocks in the S&P 500 that are mentioning tariffs on their earnings calls really jumping up here. That's what everybody is talking about, and it's also what companies are talking about right now. Also, this is kind of longer term. This goes all the way back to 1950, and this is based on macro, big picture, and markets backdrop. Equity drawdown risk remains elevated. Just suggesting here that we're kind of getting a little toppy. We're overvalued, and going down would not necessarily be a surprise based on this chart. Now, we have other charts that are still looking positive for the time being. Also, since we had the employment situation report on Friday, we also get this chart included. This is all employees, including temporary help. That's the red line. Usually, what happens when we drop below this red line here, that's when we go into a recession. And we're starting to come back up now, and there hasn't been a recession, at least as of yet. Then cheaper oil means lower inflation expectations. We have seen oil coming down. Now, there's other areas of the market that are going up, and a thing called TIPS, which I'll talk about a little bit later. These are Treasury inflation protected securities, and that's what folks tend to favor when they're worried about inflation and interest rates going up. And so this has a strong tendency to take on its lead from crude oil prices. Now, crude has been coming back down. We're down in the low 70s right now, so maybe that will help the inflation outlook. But then geopolitical things could happen too, and that could shoot oil back up. All right, the valuation looking backwards at the S&P 500. For many years now, we have been overextended. We're above the PE ratio of 20. Also, this goes back to 1980 and what the valuations were at that time. And a variation of the historically looking PE ratio was developed by Robert Shiller. It's coming in at 37.96 now. To get some perspective, we can look at the chart. We can also look at the median and the mean between 16 and 17. So we're pretty expensive according to this. Then another chart that I found interesting, this takes the Shiller PE ratio, or CAPE, C-A-P-E, and put some standard deviation lines on here. When we get too far away above the midpoint, we're getting overextended. But you can see we've been overextended for a number of years now, and the market doesn't seem to mind as long as earnings keep going up as well. And there's a lot of hype that has been really driving the market higher also. Here is the forward-looking PE ratio as of Friday's close. We also have the mega cap 8 here, and they're coming down a little bit. They didn't have a great week, but still, they're expensive at 28.6. They're above that 20 level. The S&P is also above 20, coming in at 21.8. More fairly priced now are the mid caps and the small caps, but with interest rates going up, are they going to be able to go up? They've been just treading water. This is supposed to be a positive seasonality time for them. And they keep trying and they keep threatening to break out, but then they have a good couple of days going up and then they spend the next couple of weeks going sideways to down. So we're still seeing them as fairly priced when you look at this from a PE ratio basis, but are other factors coming into play that are stifling them from going up? And here's another look at the US coming in at 22.3 when this was taken. We actually gone down a little bit since then compared to the US just with big tech when you take tech out of the picture. And then Japan, Europe, and different markets across the world. And the US has the most expensive market, but at the same time, it's considered to be the highest quality market as well as far as companies. And we look at growth versus value. This is just looking at growth where we are in an uptrend and it's been doing quite well. Value is also in an uptrend, but starting to come back down here. We look at a growth to value ratio showing growth outperforming, and we see value underperforming. And that's what we want in a more positive environment. And that really hasn't changed. And we look at the index longer term here, showing how growth is outperforming. This is shorter version showing how value is underperforming. So we're getting some confirmation here. A growth ETF versus a value ETF, still showing growth outperforming and showing how value is underperforming. And then another look at the index, again, showing how growth is outperforming. A little bit shorter term look here. And then we look at a growth versus value ETF, and I do show this every day. We're coming down into the rainbow here. We're not necessarily falling apart, but we have been seeing some weakness with this particular ratio. Then here's value versus growth, also underperforming, but has been bouncing back up, going back to the early part of 2025. Then we look at the small caps, which they're just kind of going sideways here, but their growth to value ratio is still looking pretty strong. And the mid cap growth to value ratio, the index isn't doing all that much, but somebody's coming in and doing some buying, and this tends to be more positive for things. Also looking pretty solid here with the S&P growth to value ratio as well. This is starting to break out. We're not seeing it based on price, and we're not trending right now with the S&P. We're just chopping around as all this uncertainty about tariffs and executive orders and Gaza and all those things are playing into the mix. We do want to keep an eye on inflation, especially in Friday's session. The consumer sentiment report came out and it declined, but the thing that kind of spooked the markets a little bit, number one, we hit 6,100 on the S&P, and that was the high for the day. We turned and went down from there. So we have some overhead resistance. Right about the time that report was released, the inflation component is also projecting out into the future more concerns about inflation with all the tariffs and everything that's going on right now that's hard to keep up with. So we look at a monthly chart of the CRB index where we are going up slightly here with the moving average. That's a 12-month moving average. And then we look at a ratio between inflation and deflation here, where it's still going down overall, but it has been ticking up going back to the latter part of 2024. We look at a daily chart of the CRB index, which is in an uptrend here on the daily chart. And we look at the Baltic Dry Index, which continues to go down. This is supposed to be kind of a proxy for inflation. So with this declining, because it's not costing as much to ship products in the Baltics, this is not really flagging any concerns. And then inflation expectations are tending to go up, but they're not really breaking out to the upside, and they actually declined in Friday's session. Then we just want to keep an eye on these other markets. We're still in a lazy uptrend here with aluminum. We're about ready to see a death cross here, so that's not inflationary. But corn has been really starting to go back up, and that's a huge part of the commodities market. And this could be taken as inflationary. We're not really going back up with wheat, and we're still in a downtrend there. And fertilizer starting to go up too. So you've got corn, a real basis, and then even a more basis than that is fertilizer here. So we've been keeping an eye on this. It's gone up from 525 up to 625 over the last 3 months. Oil, that's actually going down right now and is in a downtrend. We're getting to the low 70s. And we look at a gold to oil ratio, and this is going up. That means gold is outperforming. And that's what we've been seeing pretty much going back to the beginning of the year. And we look at a correlation between the 10-year yield and oil. Well, oil's the red dashed line where it's been coming down. And then the 10-year yield, which has been coming down, but then ticking back up a little bit. And we see that there's a pretty strong correlation between the two. That's why we watch oil during the day. That's why we watch interest rates during the day. And gas is still in a downtrend, but it has been going up. That could be inflationary. Natural gas also starting a new uptrend here. Heating oil also bouncing back up, but still in a downtrend. And diesel, which is starting to go back up too. So you take all these things together, and we're seeing the CRB index going up, and that's causing some fears about inflation in the market. Copper, which is in a downtrend, it's in an uptrend on the weekly chart. So longer term, it's still doing okay. It did go up a little bit because it saw some inflation things happening here, but the moving averages have not crossed yet. We look at a copper to gold ratio. When this is going down, that means copper is underperforming. So gold is outperforming. Longer term, we're also seeing the black line here going down where copper continues to underperform. We match it up with the 10-year yield and the 2-year yield where they're getting quite far apart from each other. And we're seeing this has been developing now for the last couple of years, 2 or 3 years, as we see the copper to gold ratio going down, but interest rates have been going back up, where other times they tend to move in the same basic direction. Is this the start, or not the start? Have we been evolving over a long period of time now into a new economic climate? And that's what we're trying to figure out. Longer term, we see that happening here, but now we're trying to whittle it down to more of a daily look at, are we seeing an overall change? Gold coming off of a recent all-time high and in an uptrend. Silver's in an uptrend, but still has a ways to go to get back to its all-time high. And we look at the closing price for gold, the closing price for silver, and we can see that the correlation between the closing prices are pretty strong. They both have been going up or down together. We look at a gold to silver ratio on top. When this is going up, that means gold's outperforming. And then we plot the US dollar index down here, and that's pretty much neutral right now. We're not seeing a real strong correlation. The dollar is still in an uptrend, even though it was down on the week. It's been pulling back down to its 50-day moving average. And we look at the euro compared to the dollar, and these are almost a mirror image of each other from top to bottom. It's like this is the mountains and this is the reflection on the lake. And we also put another chart together with the Japanese yen also going down right now. And then I break them out, and we're still in a downtrend with the euro to the dollar. Might be a good time to consider going to Europe. We came back up to the 50-day moving average, and now we're starting to drop back down. The Japanese yen has been coming up lately, but it's still in a downtrend compared to the dollar. And the British pound also came back up to its 50-day moving average, possibly starting to drop back down compared to the dollar. Then we look at a number of different index ratios. This is the weighted version versus the equal weight version of the S&P. And we can see that the equal weight is starting to underperform just a little bit. We were going up here with the S&P where we've been going down with the equal weight version. And we look at a ratio between the two, and this is going down the way it has been lately. That means the equal weight is underperforming. And that's where the real strength in the index comes from, are the mega caps, the real big companies that you've heard all about them. And when they really do well, the indexes do well. And we look at a ratio between stocks to commodities, where stocks are still in an uptrend, but we've really been pulling back as commodities have been stronger. This is an inverse of that same chart where we're in a downtrend with commodities, but bouncing back up. And we'll see if this is going to change into more of a trend rather than just some kind of a reactionary bounce. We look at the NASDAQ 100 and do a ratio with the S&P 500. The NASDAQ 100 continues to outperform. That's more positive for the market. The S&P 100 is starting to underperform a little bit here. Now, we're getting ready to see a death cross. This is a little bit of a concern. It's the S&P 100, which are the biggest stocks that make up the S&P 500. When the market's really strong, we see this outperforming. It's starting to show some weakness here. So we want to keep an eye on this. The NASDAQ is still outperforming the S&P, even though it's been pulling back lately. And the NASDAQ 100 is underperforming the NASDAQ itself, but it has been bouncing back up, came up to the 200-day moving average with this ratio. Is it going to continue to go up? Now, that could be positive. That just means the bigger stocks are really controlling the market. Or is it going to turn and come back down? Because we've still been going up, even with this ratio going down. That just means more than NASDAQ has been participating, which is, of course, a lot broader than the NASDAQ 100 stocks. We look at the mega caps and compare it to the equal weight version of the S&P. This is still holding up, even though it's been pulling back so far in 2025. Small caps continue to underperform the S&P. This is also another chart. This red line is the ratio between small caps and the S&P. The blue line is the S&P itself. And you can see they're kind of going in opposite directions now. Robotics and AI, that's what everyone's talking about here. We're looking pretty good. We're coming up out of the rainbow when we look at this ETF by itself and showing a little bit more promise here, coming back up to this moving average. But for the most part, it's been really underperforming the tech sector. Mega cap growth pulling back a little bit, but still looking really solid, still in a really big positive uptrend there. Okay, then the Dow Jones Composite Average, the Dow, the transports and utilities taken together, still holding up in an uptrend when you take them and put them into one composite average. Then we look at the advanced decline line. We're still hanging out slightly above the moving average here with the NYSE common stock. We're above with the S&P 500 and the mid caps, but the small caps are now starting to drop below, and they've just been treading along above and below the moving average here for quite some time. Traditional Dow theory. We look at the Dow and the transports. I also add utilities to the overall mix. Didn't quite come back and set an all-time high with the Dow. We're really showing a divergence here, negative divergence, because the transports didn't confirm that. And lately, we've been seeing the utilities underperforming. So it's like the transports and the utilities are more in step with each other, but the Dow is kind of getting ahead of things. The transports just chopping sideways, not really moving all that much lately. We look at a ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, which is what's been happening. And then we do another ratio with transports to the S&P. Also, when this is going down, which for the most part, that's what it's been doing. There's been little glimmers of hope along the way here, but the transports still continue to underperform the S&P. And then the correlation between the S&P and the transports, not really strong right now, getting back down into the neutral area. The Wilshire 5000, even though we declined on Friday, we're still above the 50-day moving average, and we're still in an uptrend with the 50-day above the 200-day moving average. Total U.S. stock ETF, also still looking pretty solid here, not seeing any great weakness, at least yet. The FANG index, this is also the really big stocks. They're still above their 50-day moving average, still in an uptrend. And this is a longer-term trend line here, which if we keep falling down, I'll extend this line and we'll see if that offers support. If we start to go up, we're concerned that this shorter-term trend line may provide overhead resistance. And then low volatility stocks still underperforming the S&P. So we're not seeing any real concern that way. When you look at the low volatility ETF by itself, it's in an uptrend. And it came all the way down to its 200-day moving average, and now it's back up to its 50. But going on this previous chart here, when we do a ratio, it might be good in and of itself, but when you compare it to the S&P, it's really not doing all that well. And then a new look at Dow theory. We look at the S&P 500 up here and the NASDAQ itself. And we're seeing a little bit of a higher high here that was not confirmed by the NASDAQ right now. So we'll be keeping an eye on that. And then we break it out a little bit further. We use the equal weight version of the S&P, not back to an all-time high, not back to an all-time high with the equal weight version of the QQQs, which is the ETF for the NASDAQ 100. ARK, since so many people own it, I bring it up in this particular video, still in an uptrend. And then the all-world ETF, when you take out U.S. stocks, coming back here, but just seeing a recent death cross. But when we compare U.S. stocks to the rest of the world, even though we're coming down a little bit, U.S. stocks continue to outperform. And then we look at a ratio between small caps and the tech sector, and both have been struggling the latter half of 2024 into 2025. So they're kind of going sideways with this ratio right now. And then a monthly chart here of the S&P to world stocks, still showing how US stocks are outperforming, but we are starting to roll over here with the PPO, which is a long-term momentum oscillator on the monthly chart. Then we look at bonds based on price coming back down to the 200-day moving average here. The hope was that we were starting to break out with price. That would push interest rates down. And the total bond ETF, this is based on price. We had come down, dropped a little below the 200-day moving average, but starting to go back up. Now, if we don't see some real strength here, and we're seeing a series of lower highs right now on this chart, this could actually turn over into a death cross and signal a downtrend. So we want to be watching that one. This is a daily chart of the different maturity rates, or maturity dates, I should say, where we've been going back up. We're starting to come back down here, and that would, if they continue to fall, would be more positive for stocks. If we keep going back up, that'll probably be more negative for stocks. Then we're keeping an eye on Japan. And I've been talking about this in the daily video, and I also do another video on the website. When we broke above 1% last summer, that's what caused the whole freak out. Well, we're continuing to go up with the 10-year yield in Japan. And is that going to come into play at some point? And the world bond index based on price are still in a downtrend. So US bonds are holding up a bit better than all the world bonds together. And we're still holding up here when we do a long-term stock to bond ratio, even though we pulled back, we are showing that stocks are outperforming. This is a daily chart showing how bonds are underperforming stocks, and we've been seeing that now for quite a while. And high yield bonds, junk bonds, still holding up quite well. Folks are willing to get into these, even though they're riskier. They like that extra yield. Corporate bonds, seeing some weakness here, trying to bounce back up. And again, if we don't see some more strength here, and we're kind of seeing these lower highs for right now, we could see a death cross with this. So we want to keep an eye on this one. And then we look at the ratio between riskier bonds like junk bonds and more conservative bonds like government bonds. We're seeing this coming down just a little bit. Interest rates on government bonds have been going up since the Fed cut rates last fall. And they keep going up, and at some point they become attractive to folks. And it's like, okay, I can get a good yield with a very conservative bond rather than taking on this extra risk to get a good yield with a junk bond. Then the correlation between stocks and bonds having a strong tendency to go in the same direction. Looking at the corporate bond index, still in an uptrend, but kind of going sideways recently. And we look at some Fibonacci retracement levels here with the 10-year yield, but we're far away from all these levels. Also looking at going into a higher range here with 10-year rates, where that would break what we've been seeing over the last 40 years. Then here's some other fib retracement levels with the 30-year yield not near any of these retracement levels. Junk bonds by themselves really holding up and doing quite well, and actually still outperforming when you compare them to more conservative bonds, but we have been pulling back. But the uptrend is still in the favor of junk bonds. Then we look at a monthly chart of the price of the 30-year, the long bond, where that's still continuing to go down, and we're starting to roll over here with the ratio between bonds to commodities. So as commodities have been going up, that's why we're seeing this rolling over. Looking at the volatility of bonds on top, that's the MOVE index, and the volatility of stocks in the middle area, that's the VIX. And seeing that there's kind of a neutral correlation right now. They had a strong correlation for a while. Now that's starting to wear off a bit. And then we look at some ratios between the S&P 500 and short-term bonds. This is still holding up quite well. And we look at the S&P 1500, another broad market measure with short-term bonds. This is also holding up fairly well. Another broad market measure, we look at 3 to 7 year bonds. This still continues to hold up. And the tech sector, the 3 to 7 year bonds, still more down into the rainbow, but not really falling apart right now. These are the clues that we'll see. If we see a lot of these ratios start to roll over and go down, that means the market's probably getting more defensive. And we're just not seeing that, at least yet. We look at stocks, the S&P 500 to the 10-year yield, kind of going sideways right now. Stocks have struggled and interest rates are going back up. And then 3 to 7 year bonds compared to stocks. When this is going down, that means 3 to 7 year bonds are underperforming. Then we look at different sectors. And first we look at an individual chart of just that sector, and then we do a ratio with the S&P. We're in a downtrend with materials and coming down and kind of hugging along its 50-day moving average, and also underperforming when we compare it to the S&P. Communication, a growth area. We want this to do well when things are positive, and this is in an uptrend by itself, also outperforming the S&P. This is one of the stronger areas of the market, and for this to keep going up would really help the S&P to go up as well. Energy just going all over the place here. Actually seeing a death cross now as we drop below the 50 and 200-day moving averages, but we're coming right back up to the same level. And when we compare it to the S&P, energy has been underperforming. And so if this really started to turn and go up, then we would be more concerned about inflation. We're not really seeing that, at least here, yet. Then the financials, we want the banks and the whole financial sector to do well, and it is. And it's one of the better performing areas of the market when you compare it to the S&P. Industrials coming back down to their 50-day moving average, they're still in a longer term uptrend and kind of underperforming a bit here. We saw a recent death cross with this ratio, but we're seeing them bounce back up just a little bit lately. The tech sector, the real darling, when this does well, the stock market does well. Fell under its 50-day moving average. It's been trying to come back up to that level. But both the tech sector and the S&P have been lagging a little bit, but still doing well. So we're seeing this ratio going sideways, and we're actually in a downtrend now with this ratio. Staples, this is a more defensive area of the market. We actually fell under the 200-day moving average. Now we're starting to bounce back up. But when we compare it to the S&P, it's still underperforming. This is another defensive area. If this was starting to really go up, like we saw at the end of 2021 going into 2022, then we would be more concerned than what we're seeing right now. Real estate, which really is, it really suffers when interest rates go up, came down, fell below the 200-day moving average. We're trying to get back above the 50-day moving average and in an uptrend by itself, but really underperforming, even though it's been bouncing back lately when we compare it to the S&P. Utilities, just kind of going sideways now. This was a stronger area in 2024. It's just been chopping around lately. In fact, it's been going down enough, so we're seeing a death cross here with this ratio as the utilities have been underperforming lately. And then we look at a S&P to utilities ratio, and I used to show this in every daily video, but we've just been chopping around, not really showing much conviction. So I dropped this from the video for right now. And healthcare, another defensive area. We're seeing a bounce back up here, but we're still in a downtrend with this sector, and it continues to underperform when we compare it to the S&P, although it has been bouncing back up lately. Discretionary, this is another growth area that we want to do well, and it has been doing well, but it's taken on some recent weakness. Ever since Tesla came out with their earnings, this has been suffering a little bit, falling under its 50-day moving average, but still in an uptrend. And coming down here, but this was a better performing area of the market when compared to the S&P. If this continues to fall, then we'll be more concerned. But for right now, this just looks like a pullback. Semiconductors, a huge part of tech, we're actually just chopping sideways. They're not really showing any leadership right now, but they're not falling apart either. And then we look at energy to tech, and when this is going down, that means energy is underperforming. If the market was getting more nervous, we would see this ratio going up, not going down. And then the tech sector to the 10-year yield, pretty much chopping sideways, getting close to seeing a death cross though. But if this really continues to fall, that would mean tech is underperforming the rise in interest rates. This is an inverse of that same chart, also getting ready to see a golden cross here. Growth stocks versus more conservative bonds, showing the growth stocks are still outperforming, even though they're coming back down to the 50-day moving average with this ratio. Discretionary, pulling back recently, but still in an uptrend when compared to staples. Staples are still underperforming discretionary, but bouncing back up lately. And gold has been doing well. The S&P has been doing well. So we're just kind of chopping around here with this ratio. We look at another ratio of gold to the dollar, where gold is now back to outperforming the dollar. The NYC composite, a broad market measure, doing quite well, still not down to its 50-day moving average. This is not falling apart, at least yet. All stocks, which looks at US and international stocks, this is holding up quite well. High leverage loans, another proxy used for the economy. It's not even back down to its 50-day moving average yet. Emerging markets have been struggling though. We're in a death cross here, but they're trying to bounce back up lately. And the Japanese Nikkei index has just hung around this red line for months now. Microcaps, really small stocks, still in an uptrend, came down to the 200-day moving average and have been bouncing back up. And we look at a correlation between the S&P and the home builders ETF. And as the S&P has been kind of floundering lately, we've been floundering with the home builders ETF. And the correlation between the two is quite strong. When we really notice this is when the correlation drops down to these yellow areas here. Bitcoin just having a really hard time staying above 100,000. It looks like it's going to break above and then it comes back down, but it's still in an uptrend. And then looking across the world here, and this is the KST, another momentum oscillator. We are in an uptrend in China. Emerging markets are in an uptrend. Europe's in an uptrend. Japan's in an uptrend. And we're still in an uptrend in the US. So this is showing that we're not seeing a lot of longer term weakness yet across the world. InterMarket Analysis going back to the beginning of 2025, where we still have gold doing the best so far. Stocks are in second place. That's the black line. Bonds based on price are up slightly. And oil is up. Everything's up right now. And even the dollar's up a little bit here, where it's been stronger. It hasn't been as strong in 2025. We look at some correlations between stocks and the dollar having a kind of a tendency to go in opposite directions. That's why we watch the dollar. So if the dollar is going up, stocks are probably going down and vice versa. The S&P and oil, also a slight tendency to go in opposite directions. If oil's really going up, that could be for geopolitical reasons, which may pressure stocks. But oil's been going down, and the S&P has really just been chopping sideways lately. We look at the S&P to the 10-year yield, also tendency to go in opposite directions. That's why we've been really watching the 10-year yield. And tech to the 10-year yield, also stronger tendency to go in opposite directions. So if interest rates are going down, that will probably help tech. If interest rates are going up, that might hurt tech. And then stocks to the 2-year yield, also a slight tendency to go in opposite directions. Then some long-term charts here. A monthly chart of the NYSE still looking solid, but if you look at the Copic curve, which is a momentum oscillator, it's starting to roll over. So we're a little bit concerned about that longer term, but price is the ultimate indicator, and we're still looking positive there. And we look at a monthly chart of the S&P, and this is starting to roll over with the PPO. This is another momentum oscillator. A little bit of a concern there. The NYSE composite, this is a daily chart where we had been really strong through 2023 and into 2024. It fell back, but it's starting to try to at least go back up. And then we look at the S&P on top, and then a ratio between stocks and commodities starting to roll over here as stocks have been consistently outperforming for the last few years. And then another monthly chart looking globally at the US stocks versus global stocks, still showing how US stocks are outperforming. And the KST, this is a long-term momentum oscillator, continues to go up. Then at the very end, we look at those things that are positive, and our list is still very long. It really hasn't changed. When you look at growth and value by itself, they're in uptrends, as is the US dollar, the CRB index, gold, silver, mega caps, the FANG index, ARK. The low volatility ETF by itself, it just underperforms when you compare it to the S&P. Staples are in an uptrend, as is the composite average for the Dow Jones. And then bonds based on price. The only ones that are really lagging right now are world bonds. The tech sector, high leverage loans, the Dow, the NYSE Composite, and Wilshire 5000. The NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. These are all still in uptrends. All stocks, emerging markets, and Bitcoin. So that's when the 50-day moving average is above the 200. Then I look at the negative side. This is when the 50 drops below the 200-day moving average. Copper's in a downtrend on the daily chart, but it's still in an uptrend on the weekly chart. The euro, the yen, the British pound, when you compare them to the dollar. And when you look at the SOX index, which are semiconductors, that's in a downtrend. But the ETFs, and I kind of come and go with showing these in the daily videos, we're lagging right now with the tech sector. So I dropped those out of the daily videos. But when you look at the ETF itself, it's SMH, it's still in an uptrend. And then the World Bond Index is in a downtrend. So thank you. I hope you found this helpful. I hope you have a great weekend, and I will talk to you in the next video.